Hello and welcome to the 6th of our CIMA F3 Financial Strategy Lecture Recaps. This lecture is on the cost of capital. First things first, what is the cost of capital? Well, remember, this is the return that's required by the investors in your business. The investors in your business will have debt and they will have equity. That's how you have financed your business, by issuing debt and by issuing equity. And the return that they will be requiring on that is interest on the debt and dividends on the equity, plus a little bit of share price increase. So the cost of your debt and equity then will be determined by the risk. So we've got to remember that there's a creditors hierarchy. At the top of that creditors hierarchy you'll have creditors with a fixed charge over business assets. They don't take a lot of risk, so they don't need a lot of return. At the bottom of that you've got your ordinary shareholders who are taking the most risk and therefore will require the most return. So the working average cost of capital is the weighted average cost to you of all of these sources of finance that you have for the business. So once again, your working average cost of capital is the average cost of the company's financing. Just remember that. So the first element of your financing is equity. So let's see how we're going to calculate the cost of that equity. And first things first, we're going to use DVM, which we used previously in business valuations, to work out the value of the business. Remember, if there's a constant dividend, the value of the share price was your constant dividend over your shareholder rate of return or your cost of equity. So flipping that around, to find the cost of equity, we need to put the dividend over the share price. So if you have a constant dividend, the cost of equity is the dividend over the share price. We did a little example in the notes. A growing dividend then, if you have a growing dividend, remember the share price is the constant dividend 1 plus your growth over your shareholder rate of return, i.e. your cost of equity, less your growth. Flipping that around again, to get the cost of equity, we need to put the dividend plus your growth over your share price now, and again add in your growth. Okay, and that will get you your cost of equity. Again, we did an example of that in the notes. Go back and refresh your memory. Weaknesses of this? Well, you're assuming constant growth, and that's probably not going to be the case. You're estimating future growth as well, which again is going to be difficult. And there's no relation to earnings. So, debt finance then. We've looked at equity. How do we value our debt? Remember, the debt is issued by the company to raise capital. It's tax deductible. It's issued in £100 units or $100 units, and it can be fixed or variable rate. We're going to look at different types of debt. We're going to look at redeemable debt. Remember, this can be redeemed at par, i.e. at the £100, or at a premium, say a 10% premium would be £110. Or you can have irredeemable debt, which doesn't get paid back, you just pay the interest on it forever. Or convertible debt, which is convertible into equity at a future date. So let's see how to calculate the cost of each of these. Firstly, irredeemable debt. Well, it's quite simple. Your annual interest less the tax, because it's tax deductible, over the market value of the debt, and that is irredeemable debt. We did a little example of that again. Redeemable debt then, remember that this is interest and the original amount which are going to be repaid. So you're going to pay interest for a certain amount of time, say 10 years, and then at the end of that 10 years you're going to pay back the £100. So what we do is we realise that the market value of that debt is the present value of all the interest that's going to be paid back, plus the capital that's going to be paid back as well. So we do a little calculation using the cost of debt. So it's the present value of the interest and capital at the cost of debt, i.e. discounted at the cost of that debt. To find the cost of debt then, we perform an internal rate of return calculation that we looked at last time. The procedure: we find the present value of the interest and the capital at a high rate, say 15%. We find the present value of the interest and capital at the low rate, say 5%. We use our internal rate of return formula, and that gives us the cost of our debt. Again, doing an example of that will help, so go do that now. Remember the tax effects on debt. The interest is tax deductible, So if you're putting the interest into your internal rate of return calculation, remember that it'll be the interest less the tax payable on it. Okay, and we did an example of that. So, what about convertible debt then? Well, remember that investors will have the choice at the end of the period. They can either convert it into equity or they can receive the cash amount. So the calculation will be the same as the internal rate of return for redeemable, but instead of using the market or the value of the cash being paid back, we will have a choice to make, and we will pay either the higher of the cash or the conversion value. You'll be given information so you can work out the conversion value, and if it's more than the cash, you would assume that the investors will choose that. So use that in your internal rate of return calculation as the amount that will be paid back at the end of the term. So we did an example of that and then moved on to any other types of debt. Well, first of all, we have preference shares. Preference shares will simply be the annual dividend over the market value. Remember, they won't be tax deductible, so it'll just be the annual dividend over the current market value of those preference shares. Bank debt is the other one, and it'll simply be the interest rate adjusted for the tax deducted on it. So how do we then put all of this into a working average cost of capital calculation? Well, first things first, we calculate the market value of debt and equity. We then calculate the weighting of each, i.e. is it 20% debt, 80% equity, 30% debt, 70% equity. Calculate that to see the weighting of each source of finance. We then calculate the cost of capital for each item using the calculations that we've just looked at, and find the weighted average of each of those sources, and that's how we calculate our WACC. Okay, so that was our lecture on the cost of capital.